Disclaimer.
Something extraordinary converged during the Martin Luther King Jr. weekend of 2026. While most Americans enjoyed their long holiday, three separate events collided in ways that should make every one of us pay attention. Financial data revealed India had quietly liquidated $50 billion in US Treasury bonds over the previous year. The US Mint suspended all silver sales, citing prices moving too fast to track. And President Trump issued a national security proclamation on critical minerals. Three different institutions, three dramatic moves, all hitting public awareness during the same 72 hours when American markets were closed. Think about that convergence for a moment. According to US Treasury data released that week, India reduced their bond holdings by 21% between October 2024 and October 2025. This marked the first major annual decline in 4 years. But they weren't just selling our debt. Reserve Bank of India disclosures showed they were simultaneously increasing their gold reserves to 880 metric tons, representing a systematic reallocation away from dollar-denominated paper assets toward hard strategic metals. You might be thinking, this is just another country diversifying its portfolio over time. Standard financial planning across multiple quarters, right? But here's where the timing gets interesting. On January 14th, 2026, the same week these Treasury figures became public, the United States Mint did something highly unusual. They suspended all silver numismatic sales, every single product line. Then, within 72 hours of markets reopening, they repriced everything 82 to 85% higher. Let me put that in perspective. If you were planning to buy a proof Silver Eagle set that cost $95 on Monday, by Thursday, the exact same product was priced at $173. The Morgan & Peace dollar sets jumped from $110 to over $200. Limited edition commemoratives that collectors had been waiting for suddenly became nearly twice as expensive overnight. The US Mint doesn't just randomly double prices. This is an institution that's been operating since 1792, backed by the full faith and credit of our government, and sudden price jumps of this magnitude signal something fundamental shifting beneath the surface. Here's what makes this convergence even more revealing. While the Mint was repricing their products at these elevated levels, physical silver dealers across America were already charging $98 to $100 per ounce. Walk into any coin shop in your town right now, ask for a Silver Eagle, and you'll see the disconnect firsthand. The Minty's outdated pricing at $91 had created a massive arbitrage opportunity that exposed a critical crack in the system. The paper price showing up on financial websites was not matching what real metal actually costs when you try to take physical possession. Have you noticed how often the official numbers don't quite match reality anymore? You check your grocery receipt and wonder how inflation is supposedly only 3%. You look at home prices and scratch your head at the official statistics. This gap between paper and physical markets isn't just an academic curiosity for traders. It represents a fundamental crack in the pricing mechanism that determines the value of strategic assets our entire economy depends on. Now, January 14th wasn't chosen randomly for the Mint announcement. That exact same day, President Trump issued a Section 232 national security proclamation. This isn't typical trade policy. Section 232 authority comes from the Trade Expansion Act of 1962, and it's only invoked when the president determines that imports threaten to impair our national security. It's been used fewer than a dozen times in modern history for steel, aluminum, and now critical minerals including silver. Silver was officially added to our critical minerals list back in November 2025, alongside copper and uranium. According to the US Geological Survey, we're importing 64% of our silver consumption. Let that number sink in for a moment. Nearly 2/3 of a metal our government just classified as critical for national security comes from foreign sources. We're not talking about luxury goods or consumer electronics. We're talking about a material essential for defense systems, solar panels, medical equipment, and electronic warfare capabilities that our military and industrial base cannot function without. But wait, there's another layer to this convergence that makes the timing even more strategic. China controls 60% of global silver refining capacity. Think about what that means. Even if we mine silver domestically or import raw ore from friendly nations like Mexico or Peru, the refining process that turns raw material into usable metal is overwhelmingly controlled by a single nation that's been systematically reducing its exposure to US dollars. The raw ore goes to China, gets refined in Chinese facilities, and then gets sold back to global markets at prices China has significant influence over. Pop quiz. When a country needs massive amounts of a strategic metal for their economy, and they've just liquidated $50 billion in bonds over the course of a year, where does that money go? They're not converting those proceeds to cash and leaving it idle. According to Reserve Bank of India statements, they're redirecting capital into hard assets. Gold reserves increased substantially, But gold isn't the only metal India needs in enormous quantities for their national development plans. India has committed to installing 500 gigawatts of solar capacity by 2030. To put that in perspective, that's roughly 5 times the current total solar capacity of the United States. Every single solar panel requires silver paste for conductivity, typically about 20 grams per panel. This isn't optional or substitutable with current technology. The photovoltaic cells literally cannot function without silver creating the conductive pathways. We're talking about inelastic demand from a sovereign nation with 1.4 billion people. And that nation just demonstrated over the past year they're willing to make bold portfolio reallocations away from our bonds. Let's connect this to your personal situation for a moment. If you're planning retirement, you probably have some exposure to bond funds. Maybe you've got a traditional 60-40 portfolio that financial advisors have recommended for decades. If you're watching your investment portfolio, you've noticed the volatility. What you might not realize is that the same dynamics forcing India to diversify away from our bonds over the past year are creating pressure on every dollar-denominated asset you own. When major foreign holders decide our bonds aren't worth holding, that's not just their problem. It becomes our problem through interest rates, inflation, and currency devaluation that hits your savings and your purchasing power. The physical silver market that same weekend told a story the paper markets couldn't hide. Premiums in Asian markets exploded to $12 to $18 over the official spot price during the holiday period. Think about that dynamic. The official spot price might show $28, but if you're in Singapore or Mumbai trying to buy physical silver, you're paying $43 to $46. When you're paying a premium that large just to take delivery of metal, you're not making a speculative bet. You're acknowledging that the official price has become disconnected from physical reality. You're paying what the market actually clears at, not what the paper contracts claim the price should be. Here's what should make us pause and think carefully about this convergence. The US Mint's suspension of sales wasn't due to lack of demand. According to industry sources and the Mint's own statements, it was a supply issue combined with pricing that couldn't keep pace with market reality. The same government institution that is supposed to ensure Americans can acquire our nation, as official silver coins, could not source enough metal to meet demand at the published prices. They literally had to stop selling because they couldn't get inventory at prices that made economic sense. Our own mint in our own country, for our own strategic metal that was just designated critical for national security. Trump's Section 232. The proclamation establishes a 180-day window for implementing what they're calling minimum import price floors on critical minerals. That's bureaucratic language for something quite significant. It means making below-cost imports illegal. If you're following the logic here, this fundamentally changes how the paper market can operate. For years, futures markets have been able to set prices based on contracts that rarely result in physical delivery. But if the government establishes minimum import prices based on actual production costs, suddenly those paper games have real-world constraints they haven't faced before. Think about this scenario unfolding. You are a trader who's been selling paper contracts for silver at prices below what it costs to actually mine, refine, and deliver physical metal. That strategy works beautifully as long as most contracts settle in cash and nobody demands delivery. You can suppress prices, make money on the spread, and never worry about actually having the metal. But what happens when major sovereign buyers start demanding physical delivery? Your government makes it illegal to import metal below production costs, and the official mint can't even keep products in stock. The entire fractional reserve system that has kept precious metals, prices artificially low, suddenly faces constraints it's never had to navigate. The weekend this data dropped and these announcements hit, American investors couldn't fully respond. Our markets were closed Friday evening through Monday. Our coin dealers were observing the holiday. Our mint was preparing its suspension notice. And while we were enjoying barbecues with family and taking an extra day off work, the global financial architecture was revealing shifts in ways that will affect every American's purchasing power and investment returns for years to come. This isn't about predicting the next hot trade or finding a get-rich-quick scheme. This is about understanding a systematic restructuring happening in real time, with multiple data points converging during the same week to tell us something important. When a nation systematically liquidates $50 billion in our bonds over 12 months while increasing gold reserves, when our own mint can't keep silver products in stock at any price, when the president issues national security proclamations about import price floors, these aren't isolated events. They're connected pieces of a larger puzzle about where value and risk are flowing in the global financial system. The question we need to ask ourselves is simple but profound. If one of the world's fastest growing economies spent a year moving away from dollar-denominated paper assets toward hard strategic metals, if our government just classified silver as critical for national security, and if physical markets are showing massive premiums over paper prices, what are these institutions seeing about the next phase of global finance that most Americans are missing? And more importantly, what should we be doing to protect ourselves before the convergence of these trends becomes impossible to ignore? Let's dig into what that Section 232 proclamation actually means in practice, because the implications go far beyond typical trade policy. When President Trump signed that document on January 14th, he wasn't just directing negotiations, he was establishing a legal framework that fundamentally changes how critical minerals can enter our country. The proclamation specifically directs the Commerce Department and US Trade Representative to negotiate agreements promoting the adoption of price floors for trade in processed critical minerals and their derivative products. Read that language carefully. Price floors, not tariffs that can be negotiated down or waived. Price floors mean establishing minimum prices below which imports cannot legally enter the United States. According to the White House fact sheet released alongside the proclamation, if satisfactory agreements aren't reached within 180 days by July 13, 2026, the president may implement alternative remedies, including those minimum import prices for specific critical minerals. This isn't a suggestion, it's a deadline with enforcement mechanisms built in. Think about what this does to the paper silver market that's operated for decades. Futures contracts on COMEX have historically set prices through a system where most contracts settle in cash, not physical delivery. Traders could sell contracts at $28 when actual production costs were $35 because they never intended to deliver real metal. They were trading paper promises, not physical silver. But if the US government establishes that imported silver cannot enter below, say, $40 per ounce, because that's the actual cost of mining and refining, suddenly those paper contracts face a problem they've never confronted before. You can't deliver physical silver at $28 if it's illegal to import it at that price. The entire leverage system that's kept silver prices suppressed for years starts to break down when government policy requires prices to reflect actual production economics rather than financial engineering. This is why the timing matters so much. India spent a year liquidating our bonds. Trump signs the proclamation. The mint suspends sales because prices are moving too fast. These aren't coincidences. These are coordinated responses to a market structure that's becoming untenable. Now let's look at what happened in physical markets during that same holiday weekend, because the evidence of stress was impossible to hide. According to multiple bullion dealers and trading platforms in Singapore, Hong Kong, and Mumbai, physical silver premiums exploded to $12 to $18 over the official spot price. Let me explain what that means in practical terms. If the paper spot price on COMEX showed $30, buyers in Asian markets were paying $42 to $48 for actual physical metal they could hold in their hands. That's not a normal premium. Typical premiums for silver run $2 to $4 over spot for standard bullion products. When you're seeing premiums triple or quadruple, that's not market inefficiency. That's a breakdown in the connection between paper and physical markets. It means people with actual capital are willing to pay massive premiums to secure physical metal because they understand the paper price is not reflecting true scarcity. They're front-running what they see coming. What makes India's position particularly interesting is the specific nature of their silver demand going forward. Their commitment to 500 gigawatts of solar capacity by 2030 isn't a vague aspiration. It's a concrete national development plan with timelines, funding, and regulatory frameworks already in place. The National Solar Mission and subsequent policy updates have created binding targets that India's government must meet to achieve their energy security and climate goals. Each solar panel requires approximately 20 grams of silver paste for the conductive pathways in photovoltaic cells. Do the math with me. 500 gigawatts of capacity translates to roughly 5 billion individual panels over the next 4 years, accounting for panel efficiency improvements and capacity factors. That's 100,000 metric tons of silver, 100 million ounces, just for India's solar build-out. And that's before we count their electronics manufacturing, their growing EV sector, their medical equipment production, or any investment demand from India's massive middle class that's increasingly turning to precious metals. This creates what economists call inelastic demand. India can't substitute another material for silver in solar panels without fundamentally redesigning their entire solar infrastructure, which would delay their energy transition by years and cost tens of billions more than just buying silver at higher prices. So they'll pay whatever price is necessary to secure supply. They're not trading silver. They're acquiring a strategic input for their national development plan. That's a completely different type of buyer than speculative traders or even typical industrial users. Now here's where the US government's own requirements start competing directly with India's needs. And this is where the math becomes genuinely concerning. According to US Geological Survey data, domestic silver production in the United States runs approximately 32 million ounces annually. Most of that comes as a byproduct of other mining operations in Nevada, Alaska, and a few other locations. We're not primarily a silver mining nation. We're importing the majority of what we need, But the Section 232 proclamation doesn't just establish price floors, it also contemplates strategic stockpiling. And industry analysts who've reviewed the Commerce Department investigation that preceded this proclamation estimate the government's strategic reserve targets for silver could reach 27.7 million ounces initially. That's 85% of 1 year's total domestic production. Before any of that, silver goes to defense contractors building weapon systems. Before any goes to solar panel manufacturers. Before any goes to the electronics industry that depends on silver for everything from smartphones to data centers. Before any investor can buy a single coin. Let's put this in perspective you can relate to. Imagine if the government announced they were buying 85% of this year's wheat harvest for strategic reserves. What would happen to bread prices? What would happen to pasta, cereal, and everything else that depends on wheat? The remaining 15% would have to satisfy all private demand, and prices would explode because the government doesn't care about price. They care about securing supply for national security purposes. They'll pay whatever it takes. That's the situation developing in silver, except it's even more constrained because silver has a 7-year deficit running, where industrial demand has exceeded mine supply every single year. There's no inventory surplus sitting around. The London Bullion Market Association vaults, which hold the largest above-ground stockpiles of investment silver, have seen inventories decline steadily as industrial users and investors both compete for available supply. We're not dealing with abundant supply and new demand. We're dealing with tight supply and multiple new sources of demand all hitting simultaneously. The historical parallel that keeps coming up in conversations with commodities analysts is the uranium market of 2006 through 2011. Uranium traded in a narrow range for years until a combination of supply disruptions, new nuclear plant construction, and strategic buying by governments created a supply squeeze that sent prices from $20 to $140 per pound in less than 18 months. Most investors missed it because they were focused on gold and oil. The smart money that recognized the supply-demand imbalance early made returns that changed their lives. Silver is setting up with similar dynamics, but potentially more extreme because the industrial demand is more diverse and less substitutable. You can delay nuclear plant construction if uranium gets too expensive. You can't delay silver demand for solar panels when your country has legally binding climate commitments. You can't substitute silver in defense electronics when weapon systems are already designed around silver's unique properties. You can't easily replace silver in medical applications where its antimicrobial properties are essential. The White House fact sheet accompanying the Section 232 proclamation specifically mentions that the Commerce Secretary found the United States is too reliant on foreign sources of processed critical minerals, lacks access to a sufficiently secure and reliable supply chain, is experiencing unsustainable price volatility with respect to critical mineral markets, and is suffering from weakened domestic manufacturing and production capacity. That language isn't generic boilerplate. That's a legal finding that justifies extraordinary government intervention in markets. When the government makes that determination, everything changes. Defense Production Act authorities can be invoked. Strategic stockpiling begins, import restrictions get implemented. And critically, price controls that favor domestic production over foreign imports get established. All of those mechanisms favor higher prices for the strategic metal in question because the goal is not cheap imports anymore. The goal is secure domestic supply regardless of cost. India understands this game because they're playing it too with their own strategic materials. They've restricted exports of various minerals when they determine domestic needs should take priority over export revenue. China does the same thing, which is why they control 60% of silver refining despite not being a major silver mining nation. They understood decades ago that controlling processing capacity gives you pricing power, even if you don't control the raw material. The evidence is piling up from multiple independent sources, all pointing to the same conclusion. Physical premiums are exploding. Government policy is shifting towards supply security over price efficiency. Major economies are liquidating dollar assets and buying strategic metals. Our own mint can't keep silver products in stock, and the legal framework is being established to prevent below-cost imports that have kept prices artificially suppressed. None of this is secret information. It's all public data from government agencies, central banks, and market reporting services. But most Americans aren't connecting the dots because the financial media keeps discussing silver as if it's just another commodity following normal supply and demand curves. This isn't normal supply and demand anymore. This is strategic competition between sovereign nations for control of materials essential to economic and military power in the 21st century. That's a completely different game with completely different rules and completely different price outcomes. The 180-day clock on that Section 232 proclamation isn't arbitrary. It's a negotiating deadline to give foreign suppliers time to accept the new framework before enforcement begins. July 13th, 2026. Mark that date. That's when minimum import prices could become enforceable law. That's when the paper market's ability to set prices disconnected from physical reality potentially ends. And that's when everyone who did not to position themselves ahead of this shift will be trying to buy silver at prices that reflect actual scarcity instead of financial engineering. Now let's run the numbers that explain why this situation becomes mathematically inevitable, not just theoretically possible. We're going to look at the convergence of sovereign demand, available supply, and what happens when multiple governments compete for the same finite resource at the same time. This is where the abstract concepts become concrete calculations that point to specific price levels and specific timelines. Start with India's $50 billion Treasury liquidation over the past year. That capital went somewhere. We know significant portions went into gold based on their disclosed reserve increases, but let's be conservative and assume India redirects just 10% of those proceeds into silver over the next 6 months as they build out their solar infrastructure. 10% of $50.7 billion is $5 billion. At current market prices, around $90 per ounce, $5 billion buys approximately 55 million ounces of physical silver. Now add the US government's strategic reserve requirements. Industry analysis of the Commerce Department. As Section 232 investigation suggests initial stockpiling targets around $1.25 billion worth of silver. At current prices, that's roughly 13.7 million ounces. So we have two sovereign buyers with combined demand of 69 million ounces, and neither is price sensitive. They're acquiring for strategic purposes. They'll pay whatever the market demands to secure supply. Here's where the math gets uncomfortable. According to the Silver Institute's latest supply-demand analysis, total annual silver mine production globally runs approximately 800 million ounces. But industrial fabrication demand, the silver that goes into solar panels, electronics, medical devices, and manufacturing processes that can't be recovered, consumes about 600 million ounces annually. That leaves 200 million ounces for investment demand, coinage, and any strategic buying. Except we just calculated that India and the US government alone could account for 69 million ounces of that 200 million ounce surplus. That's 35% of available supply after industrial needs are met, and we're only talking about two buyers. What happens when China decides to stockpile silver for their own solar build-out and defense applications? What happens when other nations recognize silver's strategic importance and start building reserves? What happens when investors worldwide see governments competing for supply and decide they want to position themselves ahead of the obvious price adjustment? The available supply gets allocated to whoever's willing to pay the highest price. That's how markets clear when demand exceeds supply. And right now, we're heading into a situation where sovereign demand alone could consume most of the available supply, pushing prices to levels where investment demand gets priced out entirely unless people act before the competition intensifies. February 26th, 2026 is another critical date you need to understand. That's when the US Mint has announced they'll release the delayed 2026 Silver Eagle proof coins. These aren't the coins suspended in January. These are new products with new pricing that reflects the new reality. The Mint has already established the pricing framework with their 82% increase, moving proof Silver Eagles from $95 to $173. That's not a temporary spike. That's the new government-backed price floor for official US silver coins. Think about what that means. Our own government is validating that silver products should be priced around $100 per ounce or higher, not through policy statements or projections. Through actual pricing of actual products, they're selling to actual customers. When the February 26th release happens, it confirms that the $100 plus pricing isn't a market anomaly. It's the new baseline that the US government considers appropriate for a critical strategic metal. This is happening while the Trump administration evaluates those minimum import prices under Section 232. If the Mint is comfortable selling at $173, what do you think minimum import prices will be set at? They're not going to undercut their own Mint's pricing. They're going to establish floors that protect domestic producers and ensure strategic supply security. That probably means import floors in the $100 to $120 range minimum, effectively eliminating the paper market's ability to set prices below production costs. Now let's talk about the leverage ratio that's about to break. The COMEX silver futures market operates on what industry insiders estimate is approximately a 4,000 to 1 paper to physical ratio. That means for every ounce of physical silver actually available for delivery, there are roughly 4,000 ounces worth of paper contracts claiming ownership of silver. This works fine as long as most contracts settle in cash and nobody demands physical delivery. It's a fractional reserve system exactly like fractional reserve banking. But what happens when sovereign buyers start demanding physical delivery? What happens when the US government establishes minimum import prices that make it unprofitable to deliver physical silver at paper contract prices? What happens when major industrial users realize they need to secure physical supply before strategic buyers lock up available inventory? The fractional reserve system breaks. You can't deliver 4,000 ounces of physical silver when only 1 ounce exists. When that leverage breaks, prices have to rise to a level where the market clears, where physical supply and physical demand reach equilibrium without the artificial suppression created by unlimited paper contract issuance. Multiple commodities, analysts who have studied previous fractional reserve breakdowns in other markets suggest silver would need to trade somewhere between $450 and $540 per ounce to break the current leverage system and establish a sustainable physical market price. That range isn't based on speculation. It's based on calculating what price level would reduce investment demand enough to balance against available physical supply after industrial and sovereign needs are met. At $90, everybody wants silver. At $500, investment demand drops significantly, industrial users pay what they must, and sovereign buyers still secure what they need because they're not price sensitive. That's where markets find equilibrium when fractional reserve systems collapse. The timeline for this adjustment is accelerating faster than most analysts expected even 6 months ago. India's Treasury liquidation happened over a year, but their silver acquisition could happen over months once they commit capital. The Section 232 deadline is July 13th, just 6 months from now. The Mint's repricing validates 3-digit silver prices starting in February. China's 60% control of refining capacity means they can restrict supply whenever their strategic interests require it. All of these factors are compressing what might have been a multi-year adjustment into a period of months. You're watching a perfect storm develop in real time. Limited physical supply, surging industrial demand that can't be delayed, sovereign buyers entering the market with non-price sensitive demand, government policies shifting from favoring cheap imports to securing domestic supply. A fractional reserve paper market that's been suppressing prices for years, suddenly facing delivery demands it can't meet. And a critical deadline in July when minimum import prices could eliminate the paper market's leverage advantage entirely. This is the moment that comes once in a generation if you're lucky. The moment when market structure changes so fundamentally that prices have to adjust to new realities, and the people who recognize it early enough to position themselves capture returns that transform their financial futures. We saw it in uranium in 2006. We saw it in palladium in 2000. We saw it in rhodium in 2008. Every time a strategic metal faces a supply-demand imbalance combined with industrial necessity and sovereign competition, prices explode to levels that seem impossible until they happen. The difference with silver is the market structure is more leveraged, the industrial applications are more diverse, and the number of sovereign buyers is larger than those previous situations. That suggests the price adjustment could be more dramatic and more sustained than historical precedents. It also means the window to position yourself is narrower, because once sovereign buying accelerates and minimum import prices get enforced, the physical premium alone could make silver inaccessible to average investors at anything near current prices. What should you do with this information? That's your decision, based on your own financial situation, risk tolerance, and investment horizon. But understand what's happening isn't speculation about what might occur. It's analysis of what's already occurring based on published government data, official policy changes, and observable market behavior. India liquidated the bonds. Silver is on the critical minerals list. The Mint suspended sales and repriced dramatically. The Section 232 proclamation is active with the July deadline. Physical premiums are exploding. These are facts, not predictions. The calculation is straightforward. Sovereign demand plus industrial demand exceeds available supply after mining production. Prices must rise to clear the market. The only question is whether that adjustment happens gradually over years or rapidly over months. Everything we are seeing suggests rapid adjustment is more likely because the government policies and sovereign buying patterns are forcing the issue rather than allowing markets to gradually adapt. We're at the beginning of a repricing event, not the end. The convergence that happened over Martin Luther King weekend wasn't the climax. It was the opening act. The real shift happens between now and July when policies get enforced, sovereign buying accelerates, and the market structure that's kept prices suppressed for years finally breaks under pressure it can no longer withstand. This is your advance notice, while the window to act is still open. What you do with that notice determines whether you're positioned ahead of the shift or trying to catch up after prices have already adjusted to reflect the new reality.